Thanks for tuning in to the 12% Solution YouTube channel. Now, the premise behind the 12% Solution, which is the trading strategy based on the book by David Allen Carter, is based on a hedge to help smooth out volatility and protect the portfolio during equity downturns. That hedge is made up of bond funds. But with inflation spiking and interest rates on the rise, will bond funds be up to the task? How will the strategy handle a rising interest rate environment? Over the past couple of months, a number of subscribers have expressed concern over the ability of TLT to continue to provide a meaningful hedge to the 12% Solution trading strategy. The fear, shared by a number of market analysts, is that the rising inflationary environment we find ourselves in will definitely lead to rising interest rates, which will most definitely lead to rising yields on Treasury bonds. And when yields rise, bond prices fall. Most at risk are Treasuries with long-dated maturities, of which TLT is a shining example. And TLT is a prominent component of our strategy. While TLT isn't the only hedge in our model, it is the asset most likely to be called on to do the heavy lifting in times of market crisis. So, will this popular bond fund step up when needed? Well, we believe it will. But we do expect TLT to undergo periodic repricing in the coming months and years, especially when all the talking heads are focused on rising inflation and Fed action to combat that inflation. Repricing, as you may have guessed, is a fun way of saying correcting or crashing, or at least falling prices. But we do expect such repricing episodes of TLT to be temporary, followed by a leveling out of pricing and a resumption of the old negative correlation with stocks, until the next repricing. While we don't envision TLT to be quite the same wealth generator it has been for the past 2 decades, we do expect that it will continue to provide an adequate hedge to equities when push comes to shove. Here's a graphic of TLT repricing, or correcting, during the first quarter of 2021. Yes, that was ugly, with a drawdown hitting negative 13.9%. The catalyst? Non-stop talk about rising inflation and uncertainty over the scope and timing of Fed actions. But, lest you think the bottom would continue to fall out of the fund, after all, inflation chatter only continued, let's pull back and look at the entire year. Beginning in the second quarter, TLT began a choppy rise back up to within a few percentage points of its high for the year. Why the turnaround? Well, it actually flummoxed the experts, who collectively predicted yields would continue to rise, and thus bond prices continue to fall. Well, here's our take on it. After months of single-minded focus on inflation, long-duration Treasuries repriced, corrected, hard. At that point, TLT was free to allow other marketplace concerns to influence pricing. Concerns like the stock market being priced for perfection, expanding bubbles in select asset groups, and the possibility that the Fed meddling could short-circuit the recovery. So in other words, TLT resumed its role as a hedge and safe haven. This was particularly evident on Friday, November 26, 2021, when the Dow plunged more than 900 points and the S&P 500 lost over 100, or a little over 2%. But TLT? It closed up 2.5%, more than making up for the loss in the S&P. It won't always be this clear-cut. The negative correlation between equities and bonds that has generally held up for years can go positive at any time for reasons that we can't quite predict. And another repricing episode for Treasuries is always hanging out there like a matzo ball. But if 2021 was any indication, TLT may be down, but not out, as a hedge to equities. That being said, TLT is not the only tool in the tool bag for battling marketplace uncertainty, inflation-related or otherwise. In fact, the 12% Solution calls on corporate bonds from time to time to provide that hedge to equities, specifically high-yield corporate debt, also known as junk bonds. As readers of the book know, the hedge portion of our strategy toggles between TLT and JNK, the high-yield corporate bonds ETF, based on defined conditions. High-yield corporate bonds are important in this mix because they are valued on credit risk. On the other hand, Treasuries are saddled with interest rate risk. Given inflation worries, these two funds can behave quite differently. Here's how JNK rode out the storm taking place in TLT. That blue line is JNK, sailing across the top of the chart and ending the quarter slightly positive. Importantly, when TLT was undergoing its first quarter repricing, the hedge portion of our strategy was in JNK. And pulling back to look at the entire year, in the end, TLT was selected by the strategy for a total of 5 months in 2021, and JNK was selected for 7 months. That resulted in the hedge portion of the strategy contributing 1.5% to the overall strategy returns of 21.9%. Now granted, that's not a huge contribution, but the larger point is that our hedge portion dodged a major repricing event early on and ended the year with a gain, in a year that saw Treasuries, especially long-duration Treasuries, beaten up from inflation worries and the looming threat of rising interest rates. And most importantly, our hedge continued to provide downside protection to equities. In the end, here's our bottom line. From a hedging point of view, TLT is the preferred fund in the event of a market crash. But repricing of this fund will occur periodically while we're in the throes of escalating inflation, diminishing its overall return rate, if one were simply buying and holding. JNK, on the other hand, looks likely to weather investor worries around rising inflation and interest rate hikes, while still providing some level of protection in the event of equity crashes. Because the 12% solution is an adaptive model that trades monthly, the prospects are good that we'll catch TLT when it can be most beneficial. And with a bit of luck, and when the market signals are sufficient, JNK can step in and save the portfolio from the full brunt of a TLT repricing. If you're interested in learning how to put the model to work in your investment portfolio, you'll find a link to the book in the description below. Thanks for your questions, and thanks for watching.